We did similar things for the exchange rate. That's less of an issue. I'm not going to go through this chart, but that's less of an issue. The good news is, at least in this cycle, much of the foreign currency debt seems to have been borrowed by firms with foreign currency revenues. So there's quite a big natural hedge. We're not seeing, with some notable exceptions, and China is one of them, domestically focused firms like real estate developers borrowing dollars. Again, China's the exception, but that's not typically the pattern that we're seeing across emerging markets. So exchange rate risks are perhaps lower now than they have been in previous cycles. And what about banks? Because the first place where you're going to see the stress really have an impact is on the banking sector. The good news is that emerging market banks are in a pretty good position, particularly relative to where we've been in previous crises. So here we look at what we call loss-absorbing buffers. A loss-absorbing buffer for us is Tier 1 capital plus NPL provisions minus NPLs, non-performing loans, and we measured that as a percent of risk-weighted assets. And you can see that in most cases for emerging markets, these green bars, this number is at 10% or above. That's a pretty good level. So if we were to see some corporate distress, the banks seem reasonably well positioned to cope with that. It doesn't mean there won't be any pain, but it doesn't mean that we're on the verge of a banking crisis, at least over the next few years. I've run out of time and I want to leave some time for questions. So let me, we can come back to this if you do have any questions, but let me just leave you with one final thought. And this is going to be increasingly important, and you might start to see this in newspapers and in the policy debate as we go through the next few months and next few quarters. And that is that the nature of financial markets has changed in a couple of different ways. The first way that it's changed is that banks are playing a much smaller role in financial markets. We already saw pension funds and insurance funds are playing a smaller role, and mutual funds and ETFs are playing a bigger role. But we're also seeing banks play a much smaller role in terms of acting as market makers. So if you want to sell a security, if you want to sell a treasury bond, previously you just sell it to an investment bank, and they deal with it. They give you a price, they deal with it, they provide liquidity. These guys aren't doing that anymore, largely because of regulation. They're not allowed to. You know, we've got the Volcker rule, we've got Dodd-Frank, we have the regulation in the UK, the minor rule, we have impending EU legislation. Banks just simply don't want to take on that risk anymore. So what you've seen is an increase in ownership by mutual fund assets. And again, what we've seen is mutual funds typically buy and sell much more than other types of investors. And at the same time, dealer inventory here in the US credit mutual fund market or in US credit markets has declined. So there are just far fewer market makers in markets right now, which means that when you do get big sell orders coming through during those periods of volatility, again, the exit door is getting smaller and smaller. And obviously the one variable that's going to adjust in that scenario is prices. You're going to see much more volatility at the point where people start to want to change positions. And the same is also true in emerging markets. So in emerging markets, a slightly different point, but again, another type of imbalance. Daily trading volume in local currency bond markets has actually remained fairly stable, even though we've seen a lot of issuance and a lot of foreign investors coming in. And non-residents hold more and more and more emerging market debt. And we know non-residents sell emerging market debt at the first sign of volatility. So the number of people that could exit the door is going up and up and up. The exit door is staying exactly the same size. And again, this is an issue for us when we're thinking about liquidity mismatches in markets that could amplify any volatility once it returns. So at the moment, everyone's talking about how low volatility is. We know from history that doesn't last. And when it does change, there are a couple of structural changes in markets that make us a little bit concerned that we're going to see even more volatility than people are expecting as we go forward, particularly when the Fed starts talking about raising interest rates. So let me leave it there. I've gone through a couple of different topics. If you have any questions or comments, I'd love to hear them.
Thank you, Mr. Roache. It's now the Q&A session, and it will open to the floor. Please feel free to ask any questions.
We haven't heard anything about the Abenomics. And what's your view? What's IMF view on the Abenomics?
Abenomics. Okay, so I won't touch too much on the financial side, but I think what's really interesting about Abenomics here is this is pre and post Abenomics and the IMF's own projections for certain components of GDP. So where we thought things were going to be moving before Abenomics is the blue line. So we saw a recovery in most parts of GDP, exports, investment, consumption. The dotted red line is what's actually happened, right? So this is the reality. And I think if you look at GDP, it looks pretty good, right? I mean, in fact, GDP has outperformed what we thought it was going to do. But that's pretty much where the good news stops. Because if you look at public spending, we assumed that that pickup in GDP would come even as the Japanese government were tightening fiscally and starting to move on to a more sustainable path. In fact, what we've seen, of course, is public spending just explode. Okay, so you've seen a lot of fiscal expansion. Now, they've started to address that a little bit with the consumption tax, and we're not sure whether that's a good idea, but that's where a lot of the growth has come from. What is much more worrying, and we've seen signs that this might be changing, but it's still far too early to say, is that previously we thought corporate investment was going to play a much bigger role in driving the recovery, and in fact, corporate investment has been quite weak. So at least as far as we understand it, the corporate sector in Japan doesn't buy Abenomics right now. They still don't really believe that it's going to work. I think part of the reason for that is that we saw one arrow fire, which was monetary policy, and that's fine, and that's had its effect. But the other two arrows, first of all, a credible medium-term fiscal consolidation, hasn't happened. In fact, they've done entirely the wrong thing in their tightening fiscal policy now and leaving all those unfunded obligations in the medium term untouched. So the second arrow hasn't fired. And of course, we've seen the third arrow start to be fired after the recent announcement, but let's wait and see. I mean, it's taken them 18 months to get the plan out. It's going to take another 18 months to work out whether they're going to implement even half of it. So at the moment, we're probably a third of the way along of where we need to be. They've done the easy part on monetary policy, and they probably need to do an awful lot more on the third arrow. So overall, I think it's just too early to say, and we wouldn't be overly optimistic at this point.
I got two questions. The first one is, are you worried at all about the unprecedented size of the balance sheets in the US and Japan? Second question is, having had a sort of a trial run last May, if the real thing comes when the Fed does start to raise rate, what do you think might go wrong and trigger some of the people to run for the door that you mentioned?
On your first point, we're not that concerned about the size of balance sheets. We think, I mean, obviously it's largest in Japan and the US. The US is probably where is more globally, systemically important. And actually, there's been some work done by Chris Sims at Princeton, who showed that in most scenarios, it's difficult to see adjustments in the Fed balance sheet having a systemically important effect on financial markets. So really the bigger risk is more of a fiscal risk if at some point the Fed needs to be recapitalized by the Treasury. But for now, for us, we really don't see that as much of a concern. We think it can be managed pretty smoothly. I mean, the Fed are not going to be forced sellers, by and large. What can go wrong in terms of the Fed exit? I think there are two things that people think about. First of all, an inflation shock. So suddenly the output gap is much smaller than people think, and inflation takes off. As an institution, we think that's a really low risk. So if you look at the participation rate, for example, in the US, in the labor market, it's really low. And so if the participation rate starts to rise, which we think it should, then you can get a pretty rapid pace of growth, and at the same time, the unemployment rate can stay fairly stable, which means that actually the output gap is quite large. So we seem to be quite far from the point at which we're going to see a pickup in inflation. I think a more important issue would be financial stability. So we are seeing very low interest rates in the US start to have all sorts of strange consequences in financial markets. The search for yield, leverage in certain pockets, a lot of shadow bank financing, and these are creating some vulnerabilities and imbalances in the financial system that at some point will get big enough to cause a really systemic problem. We're probably not there yet, but I think we're getting to the point where we should really start to think about it. The one person at the Fed who does talk about this a lot was Jeremy Stein. You know, he's written a lot, he's spoken a lot about it. It appears, you know, it appears that regulators and supervisors in the US are clearly aware of the problem. The issue is, do they have the tools to manage it without having to raise interest rates? Because you know, the financial stability framework in the US post-crisis is pretty new, and there's still a lot of regulators and supervisors involved, and no one's quite sure who is responsible for doing what. And then coordinating those policies to make them consistent is going to be tough. So, you know, for example, we're seeing this in the UK at the moment, where there's concerns about the housing market. The Bank of England doesn't want to raise interest rates, so it's thinking about all sorts of other macroprudential tools that it can use, but no one's really sure if they're going to work. And at some point, they probably will have to raise interest rates. And if you do start to see financial stability concerns build up and big vulnerabilities, the Fed might have to move quicker than we think. So that probably would be the biggest risk of it going wrong.
Thank you. I also have two questions. Both are actually a bit out of the scope of what you discussed. But so the first question is, what do you think is the difference in what US is doing by buying bonds versus just printing money? Is it same? I mean, for simple parlance. And second, at what size of the balance sheet do you think is the real inflation, learning from countries like Zimbabwe, where inflation is, I read from the newspapers recently, 8 billion%. What size do we have to get worried? We have to watch. We're learning from the other countries, where it really becomes a matter of, you know, inflation can go into double digits.
Right. On the size of the balance sheet and the inflation risk, I think at the moment one would really have to see an unanchoring of inflation expectations in the US longer term to really believe that this is going to create inflation today. It's clearly a risk, but so far I think it's proven unfounded, and you know, people still want to hold dollars. It's still the world's reserve currency, and it really, to a very large extent, depends on the credibility of the monetary policy framework. And the monetary policy framework in the US, I think, is still credible. You know, it's transparent, people can see what's going on, they understand what the Fed is trying to do, they know they're going to start tightening when they need to. So for now, it's probably quite a low risk, frankly. And there's lots of policy space for the Fed to keep on doing what they're doing. Is the Fed printing money? Sure. Yeah, absolutely. No, I mean, you know, they can't just print money and go to the Treasury Department and give it to them, but that's effectively what they're doing. So you know, and given that we're at the zero lower bound, there aren't too many other options. You know, the other thing they're doing is not just QE, but they're doing credit easing. So they've been buying mortgage bonds. Both of these are effectively printing money. There's no doubt. But you know, monetary policy, that's what you print money and then you bring it back. So it's money creation.